Let's do it. Let's do
Everybody's favorite occurrences. What's an occurrence and why does it matter? We talk about occurrences a lot. We talk about why it is important to, or why it can be beneficial to achieve a high number of occurrences for certain types of strategies. But I wanted to talk in detail about exactly what an occurrence is, because I think there's some nuances that could lead to an interesting discussion.
Oh, man.
Oh,
we
yeah,
need to
ready
prove
to go.
this in advance. We're going to have a lot of arguments, I think, over what an occurrence is.
What could it possibly be? I don't know, but let's get into it. So we talk, right, about trading often, and because the really goal behind trading often is achieving a high number of statistical occurrences. And the idea behind that is that it reduces strategy variance and increases the chances of realizing long-term averages over time. So if you have a strategy that is likely to have a positive expected value over time, such as a short option strategy when we look at long-term P&Ls, then in order to most likely realize that, you generally want to trade frequently and over a long period of time. But there's a little bit of nuance in defining exactly what an occurrence is. And so today I wanted to talk about it and why it kind of matters. Yeah?
Let's do it.
Let's do it. Let's go to the next slide. Okay, so for a bit of background. I'm sure you guys are familiar with doing your statistical analyses. You guys are familiar with your stats 101, right?
Of course. Yes, we live for them.
We live for the stats. We live for the stats. But when we want to analyze some kind of population or system, we typically want a large number of measurements, right, from that system. We want a large sample size to reduce sort of sampling errors and ensure that the results are statistically representative of that system. Right? If we're trying to measure kind of anything, any kind of system, any kind of population, if we want to get representative statistics, we generally want a large number of measurements from that system, right? And so when we tie this into strategies and sort of evaluating how they perform in the stock market, which is a system, right, that evolves in time, we generally want data that spans a long time and captures a variety of market conditions, which then decreases the variance of those kind of short-term fluctuations on those strategy averages and provides a more accurate estimate for sort of long-run expected behavior. Just kind of what we're trying to do. We're playing, long game, right?
Got it.
A lot of these strategies. So we generally want a large number of occurrences. That's kind of rooted in this sort of statistical basis for sort of trying to smooth out our P&Ls over time.
Law of large numbers.
That is involved. Yeah, exactly. Right. Tony, remember the law of large numbers, the central limit theorems, all of our yeah.
Tony and I probably talk central limit theorem once a day.
I can imagine, at least. It's on my mind all the time. I guarantee it. But let's go on over to the next slide. So this is kind of our background. So this, right, motivates this trade small and trade often mantra. It's based on the statistical principle and assumes that if we trade sort of consistently, small trades over a long period of time, that's going to reduce P&L variance over time, the variance of different average outcomes that sort of arise maybe from the noise in the market and brings the strategy average closer to its expected value, noting that these averages tend to be positive for a lot of the short-term or short premium strategies that we look at, right?
We built our whole career around this.
It's an important concept. That's why it's
we literally built our entire career, floor trading career around this without knowing any of this stuff.
Right.
Like without knowing anything about law of large numbers or central limit theorem, we did believe in the trade often. Not necessarily trade small, but the trade often.
And I'm sure blackjack teaches a lot of lessons as well.
Not really, because blackjack, it's ways to lose your discipline.
It's actually a really fair point.
Yeah.
It's a really, really fair point. I don't know. I like
Plus, I would argue that in a casino with negative edge, trade small, trade often is what the casino wants you to do.
Exactly.
But not what you want to do.
But I think just like that, looking at it from the context of that game helped me understand this a bit more. Just because like markets are kind of volatile and crazy and getting
that doesn't help the consumer.
It doesn't, no. But it's just more of a nice mathematical analogy that I found interesting when I was learning about this. But you're right that like it's specifically you want to trade small and often when there's evidence that there might be some kind of long-term positive expected value for that game, right?
Or at least not a negative
or at least not a negative one.
Yeah.
And, kind of gauging that there's a lot of nuances to estimating that as well. But for a lot of short premium strategies, we have done back tests and there's evidence that this might be true, right? So that's where this trade small, trade often comes from. And it's rooted in this kind of statistical principle, although these two guys figured it out all on their own, which is awesome, right? But this is all background, right? So this is kind of like where this kind of comes from, what the statistical justification for doing this is, right? All makes sense?
Yeah.
Okay, so let's go on over to the next slide. So in this sense, occurrence is really considered any completed trade with a specific underlying contract type, delta, expiration, like 16 delta, 45 DTE, SPY strangle. placing one of those trades every month or something like that is monthly occurrence. That's what we are meaning when we say the word occurrence. It's a completed trade with specific parameters, with specific underlying contract types, deltas, all that stuff. But remember that when we talk about achieving a high number of occurrences, this kind of underlying goal is that we want to minimize the impact of sort of short-term fluctuations on our strategy averages, right? We're trying to average over a bunch of different market conditions, a bunch of different sort of time-sensitive risk factors, right? So that kind of means that ideally the occurrences that we're counting towards a specific strategy should have some variation in risk profile. That's the nuance that I think maybe we don't talk about as much, but one that I wanted to kind of bring up here. So for example, if you sell a 45 DTE 16 delta SPY strangle at the open and then sell another one at noon, that might not really give you the impact of two truly distinct occurrences, right? Because the market conditions may not have substantially changed in between the time when you open the first trade and the time that you open the second trade, right?
That's possible, but we do consider those to be occurrences.
I know. So technically they are. Like in the general sense, these are just trades. But if the goal of achieving a large number of occurrences is to kind of smooth out our P&Ls over time, you're not necessarily going to get the impact of having a distinct occurrence, I guess I should say, depending on how you space out your trades.
There's a difference between, so the way that I would explain it is like how they explain things online.
Oh God, I don't know if that's how you want to do things.
No, like there's a certain number of viewers.
Yeah.
But then there's also like unique viewers.
Yeah.
So what you're talking about is unique viewers.
Sure.
We refer to everything as kind of total views.
Sure.
Because for simplicity.
Sure.
So we don't want to break everything down like and have to put an asterisk next to everything. So we don't think of things in terms of unique viewers. We think of things in total viewers.
Sure. I think that I completely understand the perspective of simplicity, and technically that is true. If you put on a trade and you close the trade, like that is an occurrence. But if your goal is to achieve occurrences with the specific intention of smoothing your P&Ls out, right?
Yeah, I understand. I agree with you.
Understanding this nuance of what the kind of unique or distinct occurrence is, I think is important, right?
Yeah, I agree.
Make sense? Yeah? Let's go to the next slide. So, under normal market conditions, right, there is usually a stronger case for counting a trade towards a unique occurrence for a particular strategy if there's like a little bit of buffer time that's passed between trades. Really what you want between your occurrences to kind of make a strong case for counting them as unique is to have a change or a shift in the risk profile of the trade. It doesn't necessarily need to have like a long time to pass in order for that to happen, right? Because like if you think about like a crazy market, or like, when the VIX contracts by 20% in a day or something like that, you have gotten that shift in risk profile that can justify counting kind of unique occurrences differently. But for normal, just regular, typical market conditions, usually how we would kind of like define that or define the strength of counting something as an occurrence is the passage of time, because a lot of these risk factors are driven by duration and changes in market conditions, which kind of take time to propagate. Make sense?
Yes.
Okay, so let's go to the next slide. So this was kind of an interesting study. I was talking with Jacob about this last night to get his thoughts. I was going to use theta to kind of measure this, but he's like, yeah, maybe just look at sort of like how the P&L variance or the P&L standard deviation changes depending on how you spread your trades out in your data set. And I thought that was a great idea. And you kind of see something really interesting here. So what we're looking at is we calculated the P&L volatility, so the standard deviation of P&Ls for 45 DTE, 16 delta SPY strangles, 2013 to present. These are held until expiration. And then we measured how this standard deviation changed depending on if we opened the trade every day, every other day, every third day, et cetera, right? How we space those trades out. So this graph shows what those P&L standard deviations are depending on how we space those strangles out in this data set, basically. So what we found is that the P&L volatility ranged from 670 to 710 when the strangles were opened between 1 to 5 trading days apart. And then it dropped to 630, so pretty significant drop when the strangles were spaced out by an average of 7 trading days or 9 calendar days.
So what are you saying with this then?
Let's go to the next slide. So there is a reason for this sharp drop, and that's mostly just because there's just this natural shift in expiration cycles, right? After about 7 trading days or 9 calendar days on average, right, then the 45-day contracts from the previous cycle were close enough in that duration to count as a 45-day occurrence, if that kind of makes sense, right? Basically, your expiration cycle shifted up, and now something that was like 50 days is close enough to 45 days to count as another occurrence. So this is just natural shifts in expiration cycles. But when we shifted over into expiration cycles, we saw a pretty significant drop in the variance of P&Ls, which kind of suggests that spreading your occurrences out far enough to, at the very least, ensure that each occurrence has a unique expiration cycle might help with smoothing out these fluctuations, these P&L variances over time in regular market conditions. And that time frame, that kind of buffer time for 45-day contracts is about 9 calendar days, at least for SPY. Does that kind of make sense?
Yes.
Does it?
Yeah. I mean, I didn't know you would come up with 9 calendar days, but sure.
It's kind of not that surprising, but it is nice to have a number, which is
it's nice to have a number. I agree.
It's kind of nice to have a number. Like if you're like, okay, I want to space out my trades to kind of, if my goal with getting these unique occurrences is to smooth out my P&Ls over time, how many days should I
think that's interesting because we've never done that before.
That's a new thing.
So you're basically saying if you have 2 of the exact same trades, 9 days apart makes them distinct and unique occurrences.
Their risk profiles are different enough, right?
The risk profiles are different enough after 9 days that they're not the exact same trade.
Right. So if I had 16 delta SPY strangles, right, and I'm trying to get that duration to about 45 days, if I'm trying to put on, however many occurrences, then spreading them out by about 9 days, right?
I got it.
That's the number. Yeah. At least from this one particular batch.
It's a good thing to have, Julia, because we never went like that. We would always say, I don't know, wait a couple of days or next day or, something like that.
Yeah. We never had any context around that.
Which is also fine.
Yep.
I got to emphasize that. It's also fine. Because remember, we're trying to make sure that we're getting different risk profiles.
Yeah,
and that can happen over a day or 2 days.
I just want to be very clear. We're talking about unique occurrences as opposed to just occurrences.
We're talking about unique occurrences.
Yes.
Like if the variable that we're trying to optimize over is smoothing out our P&L over time, and we want to maybe use unique occurrences as a way to do that, then 9 days is about, again, a lot of nuances here, but not on average, about 9 days is how much time to spread out occurrences by, at least according to this study.
Okay.
Yeah?
Yeah. That's cool.
I like
it. Neat. Next slide. Yeah. Okay. So to conclude, trade small, trade often is based on this sort of statistical principle that consistent small trades over a long period of time reduces P&L variance that might arise from like the noise in the market, right? But if the goal is to minimize the impact of these short-term fluctuations on our strategy averages, then our trade occurrences, specifically unique occurrences, should ideally have some variation in risk profile. And so one way that you can do this, obviously, like there's a lot of different factors that can cause the risk profile of a trade to change. But in kind of like regular old market conditions, one way to do this is by spreading out occurrences far enough apart to ensure that each has sort of a unique expiration cycle. And that's about 9 calendar days for 45-day contracts, at least for SPY. Good.
It's something different. I like it.
Kind of different.
Yeah, I don't want to discourage people from occurrences because like we count adjustments,
Sure.
We count recentering, adjustments, opening, closing, whatever it is.
Yeah.
We don't do a lot of like one of the things that Tony and I do that saves us a lot.
Yeah.
Is we don't like fall in love with a trade to the point where we say, okay, I put a trade on in the morning and now it's $1 better this afternoon. We're going to do more of it.
Yeah.
Like we don't think like that.
I know that was an extreme case for sure. Just
because it rarely happens for us either. So
That's
I mean, we don't really come up with that too much.
Well, this is something that I got a lot of questions about. Like every time we have a live show, I get questions about it. Like emails, I get emails about it, which is like, well, why don't I just trade 10 puts, right? That 10 occurrences. And I mean, in a way that kind of is, right? But like you're really not getting the sort of time diversification, I guess I should say, from spreading those trades out over time. So if you put on a trade every day, and market conditions change for a bunch of different reasons, those are occurrences as we define them. But when we're thinking about using occurrences as a tool to smooth out sort of these short-term fluctuations, then, getting kind of space or getting a buffer time from those fluctuations is something that's, I think, kind of important to keep in mind. But again, this is a huge simplification. This doesn't account for like all these factors that you talked about, like adjustments and rolling and like crazy changes in volatility intraday, for example. Like there's a whole bunch of factors that affect this. But this is kind of more of just for regular old market conditions, for market, index
No,
ETF options, that kind of stuff.
understood. We get it.